Well, thank you very much, and good afternoon, everybody. It's fair to say I think economists have had a pretty good year, really, and our consumption of champagne's been rising or running above average as a result. Because we discovered when we got to the end of 2017, the forecasts we made at the start of the year were pretty much on track, so that was a good excuse for a celebration. And of course, over the last 12 months, we also celebrated the fact that the Australian economy had just completed 26 years of continuous economic growth. We're now comfortably into year 27, and of course we finally overtook the Netherlands as the country with the longest running economic expansion of the modern era. So plenty of reasons to celebrate, and I think we'll keep the champagne on ice for 2018 as well. Because when I run down the list of factors that will be important in driving the economy over the next 12 months, they all look quite encouraging. So we are starting the year with a synchronised global recovery underway. Domestically, we ended last year, as I've suggested, with a fair amount of momentum behind the economic story. It is, in a sense, getting easier for the Australian economy to grow, and a fair amount of that growth story actually looks to be locked in by the nature of what's happening within Australia right now. Certainly will be a positive economic environment for Australia. When I look at the forecasts that the experts like the International Monetary Fund put out, what those forecasts show is more than half the globe will have not just positive growth, but accelerating global growth as we move through 2018. If I narrow that down to the countries that are most important to Australia, our major trading partners, what you find is that 75% of them have a accelerating growth profile penciled in for 2018. It's also a global backdrop, I think, where that upturn looks sustainable, because the sort of things we need to see happening are actually happening to keep that momentum moving. So we are, for example, seeing a lift in global trade. We're seeing a lift in global capex. And we're seeing labour markets everywhere improve at a much faster pace than pretty much anyone expected. These are all the things that will keep that positive backdrop in place. There's a couple of features of it I would highlight, though, from an Australian perspective. And that's what you can see on the chart on the left-hand side here. Shows you a couple of indicators that we track. So the purple line, for example, shows you growth in global semiconductor sales. Why do we track that? Well, it's a pretty good leading indicator for what's happening in Asia. It's growing strongly, and of course Asia is the most important part of the world from an Australian perspective. We're also seeing a skew in growth. It's pretty favourable for Australia. So most of it's to do with rising industrial production, the other line on that chart, and in the end it's global industrial production that drives the demand for our commodities, obviously a very important part of the Australian story overall. There is one risk factor here to watch, and that is the inflation story globally does appear to be turning around as well. So that excess in capacity in the global product markets that's been there for the last 10 years is pretty much gone. That excess capacity in labour markets is also disappearing very quickly. And one other indicator to watch, especially from an Australian perspective, is the chart on the right-hand side there. What it shows you in that green line, that's growth in the Chinese manufacturing output prices. So the price of all those things we like to buy from China. Well, for the last 4 years, those prices have actually been falling. China's been exporting deflation to the rest of the world, but clearly you look at the end of that chart, that's turned around. They're now exporting inflation to the rest of the world, and you can see it in the import prices into the advanced economies starting to pick up. And I highlight that in particular because of those very volatile financial markets that we've seen over the last few weeks. Well, that volatility was triggered by a bit of a reassessment about where the global inflation story was going and what central banks might have to do with interest rates as a result of that. So certainly something to look at very closely, and certainly something that tells you to be prepared for volatility in financial markets to continue through this year. Well, if we come back to the domestic story, Australia did, as I say, end last year with a fair amount of momentum behind that. And I think one interesting way of illustrating that is what's called the Purchasing Managers Survey for Australia. This survey, it's constructed by a global organisation, Market. They do it for a lot of different countries around the world. It's one of the first economic statistics that comes up each month. And that's the advert. What is it showing? Well, the chart on the left-hand side here shows you the results for the Australian Purchasing Managers Survey. Covers the bellwether manufacturing sector and, of course, the dominant services sector as well. And the way to read that chart, anything above 50 is expansion, and the further above 50 you are, the stronger that expansion is. You can see the acceleration that was coming through late last year and into the early part of this year. So it gets us off to a good start domestically. Likewise, a lot of the background conditions remain pretty favourable for growth as well. And the chart on the right-hand side shows you, I think, one of the underappreciated economic statistics for Australia, and that is unit labour costs. And what we've seen is that unit labour costs have really been tracking sideways now for 6 years or more. That flat trend has been something that's been very useful in supporting the demand for labour. So there's a lot more people in jobs today, courtesy of that flat trend, than would have been the case otherwise. And it's also something that's lifting Australia's export competitiveness, which means we're nicely placed to benefit from the benefits or from that pick-up in the global economic story. It's getting easier to grow, and why is that the case? Well, it really comes back to, of course, the sort of boom-bust cycle in the commodity story that we've seen over the past decade. And I picked out the three kind of key features of that story on this chart here. So we had a boom in commodity prices that triggered a boom in mining, construction and jobs, all very stimulatory. But of course, the last few years, those things have been receding. It's been a significant drag on the Australian economy. But the critical point, of course, is right at the end of that chart. All those kind of three indicators have either bottomed out or are in the process of turning around. So what we're essentially doing, I suppose, from a growth perspective, it's like a mathematical equation. You take out the negatives, what's left are all the positives. That's why it's getting easier for Australia to grow. And it does have some beneficial flow-on effects as well into the broader economic story. So the turn in commodity prices, for example, has lifted Commonwealth government revenues. We're running well ahead of where we expected to be in terms of the budget position for this year. And it certainly means the chances of Australia keeping its AAA rating are much improved against that backdrop. Well, where's the growth going to come from? Well, this is where I think the story becomes quite interesting, because a fair amount of the growth story does look to be guaranteed. Now, I've used this word guaranteed a number of times now in various presentations, and I always feel a little bit nervous about using that word because nothing is really ever guaranteed, particularly when it comes to economics. But if you look at what's driving Australia, we're as close to that point as I think you can get. And just to highlight some of the features, so for example, the chart on the left-hand side here, one of the drivers, again, will be the resources story. So look at the brown line, for example, all those new iron ore mines we built a few years ago are up and running, and there's a significant increase in iron ore production and export coming through from that. The next line to move is going to be the red line. As all of those LNG plants are turned on and ramped up, and we're going to see a significant increase in production and export in that sector as well. And it's a guaranteed contribution to growth because most of that gas has already been sold. So we have to produce it, we have to deliver it. It's going to be there in the GDP numbers as a result. Another feature of the chart next to it is the combination of demographics and income in the Asian region. What we're seeing has been very strong growth in incomes in Asia. In fact, per capita income in Asia is now actually above the global average. And if you multiply that by the 3.5 billion people sitting there in Asia, then you've got a very powerful driving force for the Australian economy. And where we're seeing it playing out in particular is in terms of the education boom we're seeing and the tourism boom as well. And it's important to note that while commodities are very important for Australia, tourism and education are now in our top 5 exports, big income earners for the Australian economy, and with plenty more potential upside to come from that story. The other area of guaranteed growth is infrastructure spending. It's taken a while to get it moving, but now it is. There's considerable momentum in that infrastructure story. And as this very colourful chart points out, there's a very large number of infrastructure projects, particularly to do with transport, underway in Australia right now. In particular, the point I'd emphasise here is that these are multi-year projects that have started. And because they've started, they're going to run through to completion. You typically don't stop digging a tunnel halfway through. That's why I say it's a guaranteed contribution to growth. That said, somebody did very kindly point out to me that there is a website you can go to called Bridges to Nowhere. So as I said, nothing is ever guaranteed. I do want to highlight, though, some more points about this Asian story because I think that's where the real upside lies for Australia. And one point to note is this chart. What it shows you is our attempts to estimate, well, how fast are those bits of the Australian economy that are exposed to Asian income growth, how fast are they growing? Well, the answer over the last 2 years is they've grown by about 3.5% a year. The other side of the equation, well, the rest of the economy, it's only grown by about 2.25% a year over that same period. So the question we all need to ask, which bit of the economy do you want to be in? Where's the upside? and clearly it's in those bits that are related to Asian incomes. And aside from tourism and education, and it's going to include agriculture, of course, it will include, we think, health and financial services. These are all big parts of the Australian story that can benefit from the upside in Asian income growth. And the other interesting opportunity that's emerging here that I think you can see in a similar vein is this new Belt and Road initiative that's gathering momentum. So this initiative basically involves trying to stitch together a range of countries from Asia across to Europe, down to Africa and back around to Asia again. These countries have around about 1/3 of global GDP between them and something like half of global population in them. And there's more than 60 countries in the net here. This chart kind of gives you the big picture of what that Belt and Road's going to look like. Somewhat confusingly, the road bit's the blue line, which is the sea lane, and the road bit, the purple line there, is actually called the Belt. So a bit confusing, but it's basically a massive infrastructure project designed to stitch 60 countries together, as I said. And when you think about the amount of infrastructure that will require and the potential boost to incomes in a whole range of countries beyond Asia that's going to be associated with that, then plenty of upside in that story that'll be worth getting on board early. And the experts who look at this say we're going to spend somewhere between $4 and $8 trillion on this initiative. A lot of money, and it's not something that's out there in the distance somewhere. It's actually starting to happen right now. And you can track the data on this, but new projects issued associated with this Belt and Road project, well, they're running at $145 billion a year already. So plenty of potential upside there that we should look at pretty closely, I think. Well, where are the risks in the story? Well, there's a couple I would highlight. The first of those is, again, it's something else that we're picking up from this Purchasing Managers survey that I mentioned earlier on. And what we're picking up, you can see on this chart, if you look at the green line there, what companies are telling us is the backlog of work yet to be done is building. So the orders are coming in, companies can't keep up with them. At the same time, they're reporting, the other line on that chart, that supply delivery times are increasing. So what you've got here, I think, is a good indication of some capacity pressures building in the Australian economy. And what it means is if we don't respond, if we don't see business capital spending lift, then the risk is we're not going to get the full benefits of that positive global backdrop or the positive domestic backdrop as well. So certainly business capex is an area we're watching pretty closely. The other big downside risk to Australia comes from the combination of very high levels of household debt at a time of weak income growth in the economy. I think the story here is well known. You can see the increase in household debt, the purple line on that chart. It's about 125% of GDP, 200% of after-tax income. It's a big number. As I say, it's coincided with the other line on that chart, which is quite a lengthy period of slowing and weak wages growth. You can add into the mix here high levels of job security concerns still. Households are worried about the discussion about rising interest rates in Australia and also about the pressures on their budgets from a range of sources. Now, this is a pretty toxic mix, and the point I'd really emphasise is it's been there for a number of years now. It's been there long enough that potentially it's changing the way consumers behave, and the risk we think is it makes them less responsive to good economic news and perhaps more reactive to any kind of negative shock that comes along. So that consumer side is certainly where some of the risks lie. It explains why a lot of the debate has been building up about wages growth and the need to get that moving in some fashion or the other. The other risk is, I think, that most of that debt that households have taken on is floating rate, so it has increased the interest rate sensitivity of the Australian economy. And the chart on the right makes the point, shows you what share of income is being used to service debt. Right now it's about 6%. The last time that peaked was back in 2008. And to get to that peak level, the Reserve Bank pushed its policy rate up to more than 7%. To get to that same point today would require a policy rate of only 4%. It's an indication of how much more sensitive the Australian economy is to interest rates. So, of course, where interest rates go will be pretty important for the broader economic story as well. Well, the reality, of course, is the Reserve Bank hasn't changed its interest rates since August 2016. It's been a very long period of no change. They have told us, though, that they think that themselves the next move will be up, but there's no real need to act in a hurry on that front. What they've also done over the last year that's been quite interesting is they've spent a lot of time telling us what they think a normal Australian economy looks like. So normal GDP growth is 2.75%, for example. And the little table here shows you all of the numbers the Reserve Bank has put out there about a normal economy. The chart is my attempt to squeeze them all onto the same diagram. The way to read that, around the outside is all those various factors like growth, inflation, unemployment and so on the Reserve Bank has identified. The green line is what a normal economy looks like, according to the Reserve Bank. The orange line is where we are right now. We're still a fair way from normal, so certainly no rush to change interest rates in Australia. But by the time we get towards the end of this year, we think we'll look like a lot more like normal. The case for normal interest rates will be there. And we have in our forecast the start of a modest tightening cycle penciled in for Melbourne Cup Day. Clearly an easy date to remember. And just finally, against this sort of backdrop, higher interest rates, that global story, the Australian story, we see the Aussie dollar moving a bit higher, and we've got it at 83 cents by the end of 2018. Now, I'll stop at that point, but thank you very much for your time today.